Let's check in on the markets. We have another big sell-off in stocks, especially the NASDAQ, which is down about 2.25% as rising rates spark a rout in tech. Here now is Market Gauge Group Managing Director Michelle Schneider. Michelle, is this just the beginning of the great reset to higher rates? I mean, we've had zero rates now essentially since the 2009 financial collapse. I mean, we are having to adjust to the idea that there are going to be significant rate hikes coming up this year. And is that what's going on now with the markets?
Well, definitely, but let's really define the word significant. When you go from zero, anything seems significant, but when you step back and think about, say, the last time we were in this inflationary period where rates were much higher, even if we get the 4 hikes this year and we go up, and I don't even think we'll see 4, I'd say more like maybe we'd stop at 0.75%, that's still, from a historical perspective, incredibly low rates. So it just goes to show you how overdone, especially in the growth area and the tech stocks, have come over the last several years because of the easy money and because of the zero interest rates. So some more realistic valuation may not be the worst thing.
But how high? I mean, you know, it's impossible to tell exactly how high rates are going to go up. But if they're going to lick inflation, we had Kevin Hassett on earlier. He says he thinks we're already into double-digit inflation right now. How high will rates have to go to really lick inflation?
Well, I think a better question is, can the Fed actually get the rates to where they need to be in order to lick inflation? And I think the answer right now is no, because at this point, like something today, you had the Empire Fed Manufacturing Survey. It was the 3rd worst on record month over month. And the last 2 that were worse were in February, March of 2020, right before we saw the big COVID sell-off. So we are contracting here from a manufacturing standpoint, which means the Fed is really going to have to decide what's going to be more important. And I still think that even though I agree that we're heading into much higher inflation, they may not care about that as much as they do really killing a limping economy that we've got going on for quite some time.
But the economy is going to be limping even more if we get stagflation. I mean, you know, they're really going to have to look. I mean, if we face stagflation, it's kind of hard to imagine avoiding a recession, isn't it?
Well, certainly from a stagflation, we could see a recession. That's for sure. But we do have one maybe ace in the hole, and that is the fact that at some point, this COVID situation has to get us back where at least maybe people are traveling again, people are going out again, and maybe at some point the labor force actually improves. Right now, we're looking at everything from the worst picture. And the Fed is really, I think, stepping back, hoping that inflation may have another surge, but the economy can get stronger, and then they can proceed with this plan of possibly raising rates more. We're in a really tough spot right now, economically and in terms of the market, and which is why commodities are doing so well.
Yeah. By the way, with these new trucking regulations, having a vaccine mandate for the trucking industry when only 50% of truckers have had a vaccine, I mean, it doesn't look like the labor situation is going to get any better, or the supply chain issues if we only have 50% of the trucks out on the road. So it's got a lot of headwinds that we're facing here in this economy right now. Michelle Schneider, thank you very much. Good to see you.